Catalyst Pharma is down around 0.2% for the past year, and boy, 2023 has been a wild ride for this one. Today we'll be looking at why CPRX is actually giving a 10 outperform rating to this stock based on strong buy analyst consensus, increased hedge fund trends, and positive insider transactions. So we'll be looking at Catalyst Pharma, a rare disease pharmaceutical company. In their annual report, they say that they are a biopharmaceutical company focused on licensing, developing, and commercializing novel medicines for patients living with rare or difficult to treat diseases. They're currently only commercializing 3 products, the main ones being Firdapse and Fycompa, and the newest one being Agamree, which was approved by the FDA on October 2023. One main risk that I have seen from this company is that they are involved in various lawsuits against generic drug manufacturers, which are trying to start production of their biggest products. They do not have any long-term solid patents, and that is why they are in many lawsuits. However, so far they have been very successful at protecting their products, and they have not let any other generic drug manufacturer compete against them in the same market. They have 3 main strategies for 2024 and forward. The first one being the successful launch of Agamree in the US. This is their newest product that was approved in October 2023, and they are looking to enter it into the US this first quarter of 2024 or second quarter of 2024. The second one is that they seek to acquire additional products. How? Well, through M&A. This company has been doing so with their latest 2 products, and this is the way where they are trying to expand. How are they going to do this? Well, they have $140 million in cash. And the last time they actually did an M&A, apart from the cash they had built up, which is a substantial cash position, they also did a small share offering to raise more funds. And the third one is to obtain approvals for Firdapse, their main product, in Japan, which they are already doing so, and to seek approval in other potential territories in Asia and Latin America. So this is the geographical expansion comment we're always talking about, and this is very exciting for a company like this. Although this is a small cap pharmaceutical, it has ratios of a big solid company with a return on capital employed of 27%, which is a lot more than we could ask for. It's amazing. They have an interest coverage ratio of 200 times, meaning that they will not have any short-term interest risk. Then they have a cash flow conversion of 114%, which is really good. And this is basically what percentage of the net income they convert into free cash flow every year. Then their profit margins are through the roof with an 84%, and their operating margins are 48%, which is also great, especially for a pharmaceutical company. Now, this company has great growth projections. It has been growing steadily in the revenue and gross profit for the longest time. However, there is one thing I do not understand and haven't been able to look at the source of the problem, but the net margins decreased from June 2023 to September 2023, and they came down from 40% all the way to 20%. I will be looking further into this because this can be a turnoff for the investment. Catalyst Pharmaceutical is in a very good debt position. As you can see, they barely have any. They're able to cover it with their assets versus liabilities, and when comparing debt versus equity, there is hardly any debt to be seen. Their efficiency ratios are through the roof. Their return on invested capital, as you can see, is a bit deceiving, but regarding the return on capital employed that we were seeing previously at 27% is something that only big names in the stock market can brag about. Moving on to the fundamental analysis, this company gets a solid 6 out of 8, especially starting with the fact that they have very low liability risk. They have an extremely solid balance sheet, meaning that they can cover their short-term obligations with their current assets. Then this company has very strong pricing power, especially since they have been able to so far protect their products against other competitors coming in and stealing market share. And they have very solid organic revenue growth and organic free cash flow growth, as we have seen in the previous slides. Additionally, they do have an existing moat and a very solid competitive advantage based on, first of all, the fact that they were the first producers and the first developers of their medicines, and secondly, based on the fact that they have so far through lawsuits been protecting their products extremely well. The 2 things that I didn't like about the fundamental analysis for this company is, first of all, their cash flows are not consistent, and this is based on the fact that they are conducting a lot of M&A to grow, and M&A basically reduces the free cash flow that they can provide to investors. And the second one is that they do not have any dividends and they do not provide any share buybacks, but instead they are conducting share offerings for M&A. And for me as an investor, I really dislike when a company produces share offerings because this inherently decreases the value of your position. For their long-term analysis, I see two routes for growth potential. The first one being the geographical expansion of their main products, which is incredible because they are already doing so. They are entering Japan, or they're waiting for the approval to enter Japan, which is an incredibly profitable market. And then they are also looking for other growth opportunities in growth markets in Asia and Latin America, meaning that this company's management knows what they're doing. And second of all, they should focus on new product development, which again is another one of their points that they mentioned on their annual report, saying that they wanted to acquire another product and another company to increase the assortment of their products. In terms of valuation, this company traded at an all-time low in September 2020 with a PE ratio of 4 times their earnings. This would have been an incredible time to pick up on these shares, but oh well, what can we do? Now they're trading at a close to an all-time high in terms of valuation at around 24. However, this company has extremely solid growth projections. So for a company with such high growth trajectory, this I would consider a very solid price for the stock. In my eyes, I will not be buying it because I first want to clear out what happened with that earnings per share decrease in June 2023 to September 2023. However, when analyzing their free cash flow yield, which is at a 4.4%, this also suggests that the company is at an attractive valuation, since this is a lot higher than the long-term inflation rate of 3%. In terms of risks and possible challenges, I see the main one being the worsening of the competitor landscape, because alright, they have been able to keep the generic drug manufacturers away through lawsuits. However, it's only a matter of time before the FDA approves generic manufacturers to start producing these type of medicines. So this would obviously hurt Catalyst Pharmaceuticals. This is why I put it at such a high percentage. In terms of regulation, possible upcoming regulation changes are always a risk you must consider when investing in biopharmaceutical companies. Why? Because they're extremely dependent on FDA clearances and any new regulation that comes through, which indirectly or directly affects their products, will play a huge part in their revenues. Now, in terms of performance and market, I don't believe that these are main risks. Why? Well, first of all, because the company has been performing extremely solid for the last years, and because even if there is an economic downturn, medicines and pharmaceuticals are things that people will need and cannot cut back on their spending, especially when they are to treat rare diseases, as it is with the case with Catalyst Pharmaceuticals. Before moving on to the investment conclusion, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence before making an investment. But I do see this company as one that has a strong competitive advantage and one that has high return on capital employed, meaning that it creates value for the investor. However, this company does not have consistent cash flows and it's not predictable and resilient in their cash flows. So I believe that this is a good company, which will probably be a great investment. However, it does have share offerings and it isn't predictable, so it's not for me at the moment. So thank you for watching. As always, this has been the Cash Flow Compounder. There's a link below to join the free Patreon for extra content, and also a link in bio to get a free stock if you join Trade Republic or Trading 212.